The short-term rental sector, Airbnb, VRBO, and the broader vacation rental ecosystem is entering a structural decline unlike anything we have seen in modern real estate. What is quietly unfolding right now will not stay contained to hosts, management companies, or vacation towns. It will spill into residential housing markets, investment portfolios, and local economies across the United States. The narrative that Airbnb always performs, or that vacation markets are insulated, has already been disproven by the numbers. What we're witnessing is not a normal cyclical correction. It is the unwinding of an over-leveraged, oversupplied, overestimated segment of the market, one held together over the last decade by cheap capital, high travel demand, and regulatory leniency. All three of those pillars are now weakening simultaneously. This analysis breaks down exactly why the short-term rental market is buckling, what the data really shows, how financial structures are coming apart, and what the likely timeline of the collapse will be. More importantly, it explains why the fallout will spill directly into the national housing supply, potentially adding 2 million or more homes to the market at the worst possible time for leveraged investors. We will examine the structural forces, quantify the risk, analyze the geography of exposure, and map the three-phase unwinding that is already underway. This is a data-driven analysis. No speculation, no sensationalism, only the numbers, the mechanisms behind them, and the consequences they imply. Structural breakdown of the short-term rental economics. 1. Occupancy collapse. The first cracking point. Occupancy is the central metric determining the viability of any short-term rental investment. In 2021, many U.S. markets exhibited unsustainably high occupancy, 60% to 80% in markets, where long-term occupancy rarely breaks 30%. That unusual period distorted investor expectations, leading to mass acquisition based on peak cycle performance. But now the market is reestablishing equilibrium. According to AirDNA's national dataset, occupancy has fallen to 48.3% nationwide, down from 61.7% in 2022, and from pandemic highs above 70%. In oversaturated markets, Phoenix, Miami, Nashville, below 40%. This decline is not a temporary dip. It reflects a structural mismatch between supply and demand, excess inventory from speculative investors, weakening travel demand, increased price sensitivity among guests, declining consumer discretionary spending, economic uncertainty reducing non-essential travel, substitution back to hotels as hotel prices moderate. In short, the demand curve has shifted down, while the supply curve has shot upward. This is the classic setup for margin collapse. 2. Operating costs, the inflation shock no one modeled. While revenue softened, operating costs surged, insurance costs up 34.2% nationwide. Many markets have seen insurance premiums rise 150% plus. Cleaning fees, maintenance, and materials all increased double digits. Property management fees climbed due to labor shortages, utilities escalated due to rate hikes in multiple states. Critically, most pro forma projections from 2020-2022 assumed flat insurance costs, flat maintenance, continued strong occupancy, continued price growth, continued low rates, no regulatory tightening. Every one of these assumptions has been invalidated. When operating expenses rise faster than revenue, the capitalization rate collapses. That is exactly what we're seeing. 3. Regulatory pressure. A trend, not an exception. 42 U.S. cities and counties have enacted new short-term rental restrictions in the last 18 months. These include caps on total STR permits, geographic restrictions, residency requirements, maximum number of booked nights, mandatory inspections and safety retrofits, increased taxation, complete bans in some neighborhoods. The regulatory environment is shifting toward primary residence prioritization. Municipalities see STRs as drivers of housing shortages, contributors to rising rents, destabilizing local neighborhoods, a source of nuisance complaints, a pressure on infrastructure. The political winds have reversed. Most investors did not model regulatory tightening into their risk assessments. Now the rules are changing after capital has been deployed, an extremely dangerous dynamic for leveraged operators. 4. Market saturation, supply growth outrunning demand. In the last year, active STR listings increased 23.8%, travel demand decreased 12.4%. In many markets, supply growth outpaced demand by 300% or more. This is classic supply-induced price compression, too many units chasing too few guests. When any asset class experiences sudden mass participation from amateur investors, opportunistic buyers, and speculative entrants, it inevitably overshoots equilibrium. Airbnb became a retail speculative asset, not just a hospitality category. Investors piled in, copying a model that only worked under low rates and high travel demand. We're now witnessing the consequences of that herd behavior. 5. Financing structures, the real trigger behind the collapse. This is the least understood but most important factor. The majority of STR acquisitions during 2020-2022 were financed under conditions that no longer exist. Sub 3% mortgage rate. Cash-out refinances deployed as down payments. Interest-only loans with balloon payments. Adjustable rate mortgages scheduled to reset, HELOC-funded expansions. Private loans with 3 to 5-year terms. Real estate investors scaled rapidly using leverage. Now the bill is coming due. The refinancing cliff, $318 billion of short-term rental-related mortgages will reset, refinance, or come due between now and the end of 2025. At current rates, payments will rise $500 to $800 per property. 73% of STRs purchased between 2020 and 2022 will operate at negative cash flow if refinanced. Many investors do not have the liquidity to absorb multi-property payment shocks. This is the most dangerous structural point. Occupancy problems are reversible. High costs can be adapted to. Regulation can be navigated. But debt pressure is non-negotiable. When rates rise and refinancing is unavoidable, distressed sales follow. 10. Micro-market breakdown. Who is most exposed? Certain geographic markets are dramatically more exposed based on STR density, revenue declines, insurance spikes, and regulatory changes. Here's a condensed version of the vulnerability assessment. Highest exposure markets. Potential price declines 30% plus. Pigeon Forge and Gatlinburg, TN 43.7% of homes are STRs. Vacancy rates up 112%. IOY Tourism, softening post-pandemic. Myrtle Beach, SC 38.2%. STR saturation. DOM increased from 41 to 97. Seasonal volatility worsening. Panama City Beach, FL 36.12%. STR density. Booking revenue down 34%. Sedona, AZ 32.4%. STR saturation. Permit reductions of 45%. Big Bear. CA insurance costs up 176%. Limited year-round demand. High exposure markets. 20-30% declines likely. Nashville, TN, STR inventory flood, new restrictions. Austin, TX, demand down sharply. Scottsdale, AZ, occupancy collapse. Palm Springs, CA, oversupply, plus heat migration. Asheville, NC, tax pressures rising. These markets have STR saturation levels so high that any liquidation event will directly depress home prices. 3. The timeline of the collapse. This unwinding won't occur in one wave. It will unfold in 3 defined phases based on financing schedules, cash flow deterioration, and regulatory deadlines. Phase 1, the early exits, now through summer 2025. Investors most vulnerable, adjustable rate mortgage holders, owners facing balloon payments, properties already negative cash flow, operators struggling with declining occupancy. Projected inventory impact, 400,000-600,000 units. Phase 2, the mass exodus, fall 2025 to spring 2026. These are owners who, bought with fixed-rate loans but depleted reserves, cannot withstand insurance tie non-renewal, are impacted by new regulations, operate in extremely saturated markets. Projected inventory, 800,000, 1.2 million units. Phase 3, the capitulation, 2026-2027. This is the breaking point where formerly successful operators accept the structural shift. Corporate STR portfolios shrink, institutional players offload non-core assets, multi-property owners liquidate under rate pressure. Revenue declines become permanent, not cyclical. Projected inventory, 300,000, 500,000 units. Adding the phases together, total projected inventory return, 1.5 to 2.3 million homes, the largest housing supply shock in modern U.S. history. B. The broader housing market impact. Many homeowners in STR-heavy markets believe they're insulated. They are not. Here's why. 1. Price contagion is inevitable. If 20 to 40% of a neighborhood's homes were bought as STRs, a liquidation wave resets the price floor for everyone. 2. Appraisals adjust downward quickly. A handful of distressed sales can reset comps. 3. Local tax bases weaken. Lower valuations, lower municipal budgets, higher long-term tax pressure. 4. Buyers recognize desperation. Once inventory dumps begin, buyers seek deeper discounts, accelerating the correction. 5. Institutional capital won't act as a backstop. Unlike 2008, large buyers are not eager to buy vacation homes. V. Strategic implications for owners, buyers, and investors. If you own short-term rentals, conduct a full cash flow audit stress test under 6.5% to 7.5% refinance rates. Consider selling while liquidity remains. If holding, convert to long-term rental early. If you're a homeowner in a high STR area, understand that prices may decline even if you never rented your property. Selling sooner captures remaining equity. Refinancing before local comps fall is wise. If you're planning to buy, the next 12-24 months may offer best price entry points since post-2008, strong buyer leverage. Deep discounts in specific corridors. Patience in targeting the right region will matter. 6. Final analysis. Why this collapse is structural, not cyclical. This downturn is not a repeat of 2008 in cause, but potentially in magnitude. The drivers now are oversupply, over-leveraged acquisitions, unsupportable operating costs, long-term regulatory tightening, weakening travel demand, rate shock refinancing, saturation across entire zip codes. This is not a temporary slowdown, it is a structural recalibration. The housing market may absorb the shock, but not without significant price corrections, particularly in vacation corridors and investor-concentrated suburbs. For disciplined investors, this period will create once-in-a-generation opportunities, but only for those who understand the data, move strategically, and maintain liquidity when others run out of options. The collapse has already begun. The unwinding will accelerate. Those who prepare will benefit. Those who ignore the numbers will pay for it.